Hey, future CPAs. Let's talk about one of the toughest topics on the LECPA, investment in associates. You know the exact question I'm talking about, the one with all the different asset values, intercompany sales, and what feels like a million moving parts. It can be a total headache, but don't worry. In this explainer, we're going to give you a simple toolkit to break down even the most complex problems in under 5 minutes so you can absolutely crush it on exam day. You ready?
Okay, let's just look at this for a second. You see a problem like this on your exam and your brain just kind of freezes, right? You've got different assets, fair values clashing with book values, a sale that already happened. It feels like they've thrown the entire kitchen sink at you. And honestly, it's designed to be overwhelming.
But here's the secret. It's not a nightmare if you've got the right tools. And that's what we're doing today. We're going to break this beast down into simple, manageable steps. By the end of this, you'll see a question like this and you'll know exactly where to start. So let's crack this thing open. All right, first things first. Our very first tool is all about tackling that first big hurdle, the difference between the price you paid for the investment and what the associate's books say its assets are actually worth. This is where so many people get tripped up, but I promise you, it's super logical once you see it laid out. So that gap, it has a name. It's called the basis difference. The easiest way to think about it is as a premium. It makes sense, right? You paid more because you know the company's real-world assets, like its equipment or its land, are worth way more than what's written in their old accounting books. Our job now is to figure out what to do with that premium. Okay, so here's where the magic happens. We have to treat each asset's premium differently. Let's look at the inventory. Its 2 million peso excess value gets expensed in full this year because, well, it was sold. Easy enough? Now for the equipment. We take that 3 million premium and we spread it out over its remaining 4-year life. And what about the land? Since land basically lasts forever, it has an indefinite life, so we don't amortize its excess value at all. Just remember, each one of these amortizations directly reduces your investment income for the year. That's the key.
So what if you have some premium left over that you can't assign to a specific asset? Well, that becomes what we call equity method goodwill. Just think of it as the value of the company's brand name or its loyal customer base. Now listen up, because this is a crucial exam point. You do not amortize goodwill. It doesn't wear out like a machine. Instead, you just keep an eye on it and test it for impairment if you see any red flags.
Awesome. Now let's grab our second tool. This one is for another classic exam trap. Those tricky sales that happen between you, the investor, and your associate. The rule here is all about one simple idea: avoiding fake profits.
So the core principle is really simple. You can't actually book a profit until the product is sold to a real outside customer. I mean, think about it. If you sell some inventory to your associate and at the end of the year it's just sitting in their warehouse, has anyone actually made any real money? Nope. That profit is unrealized, and our job is to eliminate our share of it from the books.
And here's the best part. You don't have to get bogged down with whether it's an upstream sale from the associate to you or a downstream sale from you to them. The logic and the math are identical. You just find the profit on the inventory that's still sitting there, multiply that by your ownership percentage, and subtract it from your earnings. The goal is always the same: get rid of that fake profit. All right, on to our final tool. This one is for when things start to go south. What happens if the investment's value totally tanks or you suddenly lose your influence over the company? These are what we call the red flag scenarios. Now, you don't test for impairment just for fun. You have to wait for specific triggers. And in an exam, if you see keywords like significant decline, bankruptcy, or adverse political conditions, your brain should be screaming, "Impairment test." The test itself is simple. You just compare the investment's value on your books, the carrying amount, to what you could actually sell it for, the recoverable amount. If your book value is higher, that difference is your impairment loss.
And bam, here's a classic exam trap, so pay very close attention. Under IFRS, which is what we use in the Philippines, you can reverse an impairment loss if the investment's value bounces back. But under US GAAP, you cannot. They see it as a permanent write-down. Seriously, knowing this one little difference could easily be the single point that gets you over the passing mark.
The other big red flag is something called cessation. It's just a fancy term for when you lose your significant influence. Maybe your ownership drops below 20%, or another company swoops in and takes control. The moment that happens, you stop using the equity method. Full stop. The game changes right then and there.
So how do you know you've lost that influence? Well, the signs are usually pretty obvious. Imagine the company is publicly fighting your decisions, or you get kicked off the board of directors, or another shareholder just buys up a massive controlling stake. Any of those things happen, and your influence is pretty much gone.
From that point on, your accounting for the investment has to change completely.
Okay, you've officially got the toolkit. Now, let's lock all this knowledge in so it sticks. This is your rapid-fire study hack section. Let's go. All right, amortization checklist. First, find that excess value. Is it equipment? Amortize it. Is it inventory? Expense it when it's sold. Is it land or goodwill? Don't touch them, just test for impairment. And the number one takeaway, every single peso of this amortization reduces your income. Got it?
Next up, intercompany sales. Here's your process. Step 1. Find the profit on the goods that are still sitting there, unsold. Step 2. Multiply that by your ownership percentage. Step 3. Subtract that number from your investment income. And remember, don't overthink upstream versus downstream. The math is the same. Done and done.
Impairment quick facts. See a huge drop in value? That's your trigger. The loss is simply the carrying amount minus the recoverable amount. And for the exam, I need you to burn this into your brain. IFRS allows reversals, US GAAP does not. Lock that in.
And finally, cessation. Step 1. You confirm you've lost influence. Step 2. You immediately stop using the equity method. Step 3. Whatever the investment's value is on that day, that becomes its new starting point, its new cost basis. And from then on, you follow different accounting rules. It's a clean break.
And there you have it, a complete toolkit for even the trickiest investment and associates problems. So that question from the beginning, it's not so scary now, is it? You have the framework, you have the rules, and you've got the study hacks. Now go open up your review materials, find the hardest problem you can, and prove to yourself that you can solve it. You've got this. Good luck, future CPA.